Mä otan tähän saman alun kuin äsken. Niin. Welcome to the Green Growth Forum in Lahti and the second session of day 2. This event is organized by... Anteeksi, otetaan alusta. Warmly welcome to the Green Growth Forum and the second session of day 2. This event is organized by the European Green Capital 2021, which is Lahti, Finland. I am Unna Lehtipuu and moderating this session and more than happy to welcome you all to join us online. Some of our speakers are here here on stage in Lahti and some online, but still live. Please note you can also watch yesterday's sessions and keynote speeches on the event platform. They are readily available there. But in this session, we will focus on measurement and evaluation. We have 3 inspiring speakers, and I will shortly present them now. Our first speaker is Mr. Wilco van Heteren from Sustainalytics. Welcome, Wilco. He will highlight trends in the ESG disclosure and reporting and the current state of global and regional standards. Our second speaker is Mr. Miika Korja. Welcome, Miika. He comes from SITRA, the Finnish Innovation Fund. And he will give us valuable insights into the latest developments with evaluating biodiversity risks and impacts. And finally, we will close this session with Mr. Peter Paul van de Wijs from GRI Standards. Welcome.
Thank you, Unna.
He will help us to refine sustainability reporting for companies and investors. But now, Wilco, the floor is yours.
Thank you, Unna. Thanks to all of you attending this session. I have a few slides to present to you about the ESG ratings space, how reporting frameworks are developing, how they're being used. If you could start with the second slide of my presentation. You can go one slide. Yes, thank you. So there's a lot to say about this topic. There's also, a great amount of reports and studies available on the web. So what I am presenting here today is our own findings in, the way we, based on the way we do research, the way we talk to companies. What you see is there's an increasing, or has been an increasing amount of reporting standards being developed, and more recently you actually see some kind of conversions or at least collaborations between several frameworks to serve the use cases of those frameworks better. So in this presentation I wanted to highlight GRI. Well, I don't want to mold any grass from Peter Paul's lawn before he speaks. GRI has started some collaboration with SASB, who is typically, a reporting standard focusing on material issues. And since a couple of years, we have another climate-related framework, the TCFD, which is definitely gaining momentum, from investors. And I want to highlight here too. I could have extended this list, by also adding the CDP, Climate Disclosure Standards Board, and even more. But these 3 are the ones that I wanted to highlight here. While companies are started to use frameworks more and more often, some of them, but not all of them, also started to set their own ESG targets. So targets could speak to both E, S, and G issues. So when you think of environmental issues, the obvious one, the ones they speak to reduction in CO2, NOx emissions, waste, things like that. And on the social side, which is slightly more complicated, as I will tell you a bit later, they can focus on staff diversity, learning and development, training taken by staff, and more. If you could go to the next slide, please. So these are just some numbers, based on our own experience. And as I said, there's multiple studies, conducted by academics, by other firms like ourselves on the web. What we do as an organization, not only do we research on ESG topics, we also speak with companies to discuss their ESG performance more in depth. And what we found in North America, which is typically a market that is, let's say, is later on the curve compared to European issuers and European investors. What we see in North America is that Canadian and US companies, they do use GRI, SASB, and TCFD. GRI by far, on top. However, the number of companies that we engage with, like the minority of those, use those frameworks. If you would go to the next slide, what you see there is, if you look at the combination of companies that use frameworks versus targets, you see four options here, and the number of companies that both use reporting frameworks and ESG targets is still fairly limited. It's only 1/3 of the admittedly modest sample that we have. So what are the, let's say, the complexities around ESG reporting? If you would go to the next slide, I wanted to focus a little bit more on social issues, because that's where many companies, but also investors, find some challenges. Clearly, I think many stakeholders in this whole field agree that standardization of disclosures is necessary to drive this development forward. On the environmental issues side of things, this has been more common already, and perhaps also easier. There has been an emission trading platform. CO2 has been priced. Companies started to report on CO2 related metrics earlier on. But what you see, and especially I think last year, the year before, around COVID, and also when issues around ethnicity and racism emerged, that is really where, in our experience at least, when social issues started to be much more prominent on issuers and investors' radars. They are harder to define, and they are also harder to measure. So what you see in terms of corporate reporting in this space, many companies do report on social issues, on social targets, but very broadly. And the more precise and details those reportings become, the fewer that companies report actually on them. So one example is anti-discrimination policies. These are found in many companies' reporting. But if you look at reporting on specific initiatives supporting a diverse workforce, which is one step obviously beyond anti-discrimination, companies disclose less. But if they disclose less, you don't really know if they have such initiatives in place or not. And then if you would go one level deeper, managerial or board level responsibility for those initiatives, that is even less reported on. While as an investor, I can imagine you would like to know if there's board level responsibility assigned to these topics. Where it comes to data availability, there's also a number of dimensions to highlight here. For instance, if you would look at diversity in a company staff, what type of diversity do you then actually look at? Do you look at gender? Do you look at color, ethnicity? And I'm not even sure, to be very honest, if I'm using the right nomenclature these days. once this is clarified, so once the definitions are that the company uses are clarified in their reporting, those companies might only report on diversity for their entire staff. But it would also be interesting to look at diversity levels on the work floor versus board level diversity. So there's a lot of layers and complexity in existing reporting, and social topics by the very nature, which are also culturally determined to a large extent. Getting standardization around these topics in global company reporting is quite a challenge. Go to the next slide, please. So what you do see happening is a lot of development around regulation. And especially in Europe, from the European Union, we see a sustainable finance disclosure regulation, which has been launched, benchmark regulation, especially around climate-related investment funds. And there's this taxonomy regulation that is launched too, and investors need to respond to those regulations, need to anticipate new regulatory environment, and I can tell you that is actually quite a challenge in itself. There's also regulation around the corner around for companies like Sustainalytics, so for companies that do ESG research and that generate ESG readings. So that's happening in Europe, the US, North America in particular, but more generally, but especially the US is a bit behind this curve. But there's some topics are hotly debated. So one thing is the regulator going to impose ESG reporting standards on companies and also on investment managers? And another topic is the validity of incorporating those ESG factors, integrating those into investment decisions. And is that or is that not in harmony with existing fiduciary duty regulation? Those are big debates. As Sustainalytics, I should say we do welcome this regulation. I think corporate reporting standardization helps all stakeholders better understanding the underlying issue and better understanding how companies perform on those topics. What we do feel strongly about is that while corporate reporting, can be standardized further, it's up to an ESG research firm how to generate insights and ratings from those data points. And so for us, it's not a big, as you hear here in the market, where people wonder why are credit ratings almost equal, depending or independent on the rating agency that you look at, and why are ESG ratings so different? For us, that is not necessarily a problem. Equity ratings, for instance, also vary greatly. There's a lot of vision and opinions put into those ratings, also because they're forward-looking. So for us, that is fine as long as those providers of ESG ratings are transparent about what methodology they use and what data points they use. I can talk a lot more, but I'm also happy to leave something for the discussion. So let me end it with this. Thank you.
Thank you, Wilco. And the next speaker would be Miika Korja.
Hello everyone, and thanks for joining us today. My name is Miika Korja, and I come representing SITRA, the Finnish Innovation Fund, and today the presentation will be on the latest developments with evaluating biodiversity risks and impacts in investment portfolios. I'll try to make 4 points today in this presentation. First, what is exactly biodiversity? What do we mean by that? On the second one, what is the latest research from an academic perspective on the matter? And then third and fourth are really 2 different approaches to how biodiversity could be evaluated. So what is biodiversity and why is it relevant? In the words of Janne Kotiaho, who's the chair of Finnish Nature Panel, life started on Earth 4 billion years ago and has since spread to form really complex ecosystems on our planet. And biodiversity really is the diversity of species, genes, the breadth of life on this planet. And actually, it ends up really enabling the rest of the nature to flourish. But at the same time, 75% of land surface is significantly altered, 66% of ocean area experiencing increasing cumulative impacts, and also 33% of global fishing stocks classified as overexploited. And as you see some of the big headliners on the right-hand side, it's looking pretty severe. And also plastic pollution has increased tenfold. So we are experiencing a very, very dramatic impacts with biodiversity loss, as also identified in the planetary boundaries model by the Stockholm Resilience Institute. So what does this mean? If biodiversity is disappearing, how do people react to that? How does the media react to that? Here are a couple of headliners from earlier this year, from February, when the Dasgupta review was published on the economics of biodiversity. And some of you may recall in 2006, Lord Nicholas Stern published a review on the economics of climate change, which sort of underpinned the whole work on climate change. And we look at the work today, the work on climate on multiple different fronts is very encouraging. Sort of the similar type of a report took place this February. And Sir Partha Dasgupta basically laid out that the global financial system has a very significant impact on global biodiversity, and financial institutions must better evaluate the systemic risks caused by biodiversity loss. And as you see, these are finance and economics newspapers which are making these headliners. These are not sort of so-called, not coming from the nature perspective, but these are real economic newspapers getting really worried. Couple of points. What exactly did the report say? It's a 600-page report. I really recommend looking into it. It's very interesting. But in essence, it said that we've overlooked nature and biodiversity. And that's why HM Treasury from the UK ordered an independent review on the topic. What does nature do? Nature basically provides us with food, clean air and water, resources, energy, and a place for relaxation from a sort of mental perspective. And this is something that we don't really prize, We take it for granted. You walk into a forest, you pick some mushrooms. We might have certain parts of nature might have a price tag, such as timber, but many other aspects of nature don't have a value. So what we end up doing is that we overly start burdening the economic system. Globally, the level is our economic system basically consumes 1.6 Earths. Finland, it's approximately 3.8. So the idea is basically that nature provides us with services, but we're overusing nature, which then ends up destroying the services. That's basically the point what Partha Dasgupta ended up making. And now the two approaches, how to think about biodiversity as part of an investment decision-making process. Natural capital, in other words, biodiversity and these ecosystem services underpin our economy. According to the World Economic Forum last year, over 50% of our GDP is completely or moderately or highly dependent on nature. And that's a pretty big number when you think about it. And we don't have a price tag for these services. According to Boston Consulting Group, the global ecosystem services are estimated at $150 trillion annually. That's twice the global GDP. And we don't have a price for it. And that was on the second bullet as well. And this table is just to sort of lay out how exactly does nature underpin these services, from regulating activities, growing things, purifying things, cleaning things. This is one approach to think about the dependencies. Number two, you could also think about it from the angle of risks. Here's a study by the Dutch central bank, the Nederlandse Bank, excellent review on how dependent Dutch financial institutions are, what the impact of Dutch financial institutions is on biodiversity. And the idea is that we'd start looking at biodiversity through the same lens as for climate. So physical risks, transition risks, how does the changing are companies on the right trajectory to think about biodiversity? reputational risks and litigation risks as well. These are exactly the same risks that we think about with climate change. So this is one approach to also think about. Obviously, the first point was laid out in the previous slide, where we start evaluating the problem from the angle, how dependent are we on the ecosystem services? And there's a couple of other studies as well mentioned there below. But then one more additional angle to think about biodiversity. This is gaining traction at the moment because it's very difficult to think about. We spoke earlier in the sessions about double materiality, and this is basically the same idea. The first approach I mentioned was really about what does biodiversity loss do to companies? Now the point is about what do companies do to nature or to biodiversity? Biodiversity is something you can manufacture. You know, it's the diversity of things, right? I mean, it's not CO2. You could it's a molecule, right? I mean, you could trap it from the, using reforestation. You can capture it from air. But biodiversity is not something you can create, right? So it's really difficult to measure it with a single indicator, like tons of CO2 equivalents, which is actually pretty useful when it comes to climate change. Similar to climate change, when we make an impact on biodiversity, it takes decades before you can even observe it. Same way we pollute CO2 emissions right now, we'll see the impacts 20 years later. It's sort of the same idea. When we have these drivers for biodiversity loss, we end up observing it way later. This makes it very tricky. So analysts are suggesting that why don't we actually look at the drivers? So if we could even just lay out some of the key drivers for biodiversity loss, what about if we evaluated them? And these are the so-called IPBES drivers. IPBES is that's my timer on the watch. IPBES is basically the same thing for biodiversity as for IPCC is for climate. So this is the international panel on biodiversity and ecosystem services, and they've outlined 5 different key drivers for biodiversity loss, which I recommend reading more about. I won't have the time today to get too deep into them, but the idea being, what about if we evaluated companies' impacts on these 5 drivers, and that constituted the impact the company has on biodiversity loss? And the logic is basically the same. If these drivers are taxed or regulated in the future, and your company has a lot of these drivers, or big impact on these drivers, you are a very risky company. That's the logic. I won't dig too much into this slide, just to kind of showcase where technical solutions are going at the moment. Moody's at SITRA's webinar, they showcase some of their capabilities with remote sensing techniques. These might be some of the ways that we start looking at biodiversity loss globally going forward. And Bloomberg Terminal might be able to sort of take up this sort of technical solutions in the future. So, just to summarize, biodiversity loss has quickly manifested itself as a prominent theme for the investment system and for the financial system. Our economies are fundamentally dependent on nature and the ecosystem services, and we have a couple of databases that might be helpful when it comes to examining these dependencies. We can evaluate biodiversity risks using the same risk methodologies as for climate risks, and we could maybe think about the company impact side using these IPBES drivers. And remote sensing techniques could prove quite helpful going forward. And then there's a cartoon picture there for your information as well on the matter. Thank you very much.
Thank you, Miika. And the next speaker would be Peter Paul van der Wijs.
Yes, thank you, Unna. Good afternoon, everyone. It's certainly a pleasure to be joining this forum on such a timely topic. Sustainable finance, ESG reporting, and impact investment are hot topics. So in the coming couple of minutes, I would like to share our view on sustainability reporting, on double materiality, and the latest global policy developments, which I think will inform your decisions in the coming years. And you've heard already some from Wilco, and I'd like to expand on that a little bit. But for those of you who don't know us, let me do a little short commercial about GRI. Next slide, please. So GRI is an organization that is an international standard setter, and we create a global common language for transparency. We were initiated following the Brent Spar accident in the late 90s, and from then on we have developed the widest and most widely adopted set of sustainability reporting standards, which are freely provided to companies around the world and other organizations to communicate their sustainability impacts. Next slide, please. And by now, and we're very pleased with this, is we've reached an adoption of more than 10,000 companies have decided to voluntarily publish a GRI report and provide a better insight on the impacts they have on the society at large. And to some extent, we already cover some of the concept of double materiality, because our standards will indicate early indicators for financial impacts as well. So we're on the rise, but if you look at the total number of companies in the world, 10,000 is by far not enough. That's why I'm actually very pleased on the developments that I can discuss in the rest of the presentation. Going to the next slide, please. So during my presentation today, I really want to share with you the latest on two complementary initiatives around corporate sustainability with global impact: the proposed extension of the activities by the IFRS and the development of the European Sustainability Reporting Standards. And I want to ground these developments in a global trend that we've observed over the past years, and which we as GRI strongly support. And unfortunately, I haven't been able to listen to the first session, but it sounds like you've addressed some of those points already there. So I'm glad I can build on those. Because what we see really is a push for a future global reporting regime in which financial and sustainability reporting are mandated and on an equal footing, as two key perspectives interconnected by their respective underlying standard setting mechanisms and managed with the same rigor. Strengthened financial reporting is extremely important to gain access to capital, and something I really don't have to explain to you here in the audience today. It's further recognition of a development that environmental and social norms will matter in attracting capital and exporting. At the same time, sustainability reporting on your impacts to the world secures access to markets and customers. Next slide, please. So underlying this global trend is this concept of double materiality, which was introduced in 2019 by the European Commission in their guidelines on non-financial reporting, a supplement on reporting climate-related information. It basically states that companies need to consider both and report both their impacts on the world as well as on sustainability issues and how they impact the company. I think what's important on this slide is the next bullet, which says that it's not an either-or activity. Each direction of double materiality needs to be considered in its own right. It's not limited to topics that are only financial and impact material. It's about all those impacts together. It's also not about prioritizing financial impacts over societal impacts. It's really about both together. That's why we keep talking about they have to be at the same footing, and we have to be done with the same rigor. And then on the next slide, you'll see there's also an important element here which is related to the sequencing of reporting and collecting the information from a company. Because in order to get a full picture of your impacts and ensure that nothing is missed, companies need to start by assessing the impacts they have on the economy, the environment, and the people, so the outwards sustainability impacts, before they can actually assess which one of those have an impact on the financial health or at its value creation. So it is very important for companies to not only consider both, but also consider the right sequencing in order to ensure that topics are actually captured early enough and recognized early enough. I mean, speaker before me talked about risk management. This is classic risk management. Understand the environment in which you operate and how it at some point can impact you. Next slide, please. From a standard setting perspective, and I'll go a little bit more in that now. It's one slide further, please. There are three prerequisites that are important when you consider credibility of standards and buy-in. Sustainability reported setting process has to be multi-stakeholder. It can't just be industry determining for industry what they report on, or it can't just be one stakeholder deciding what's relevant for them, and that becoming a global standard. It has to be rooted in public interest and authoritative international governmental instruments, and it has to be governed by an independent and transparent due process in order to get the credibility. We believe it has to be mandatory, and we also believe that sustainability reports need to be assured by independent insurance providers to ensure that the data which is can be compared and is credible when compared. We just heard from Sustainalytics, the quality of the data is the core of their business. So by assuring reports that will help. And then the last thing that's not on this slide, but we talked about double materiality, and this is a conversation that is starting to happen, is we need to agree on terminology. And so in order we can compare, but we can also standardize terminology and make sure that when financial materiality talks about climate change and climate change impacts, it's the same kind of impacts that were reported from an environmental perspective. Next slide, please. Now, let me turn my attention to those two complementary initiatives with global impact, because I do think this will set the stage from a standard setting perspective for the next coming years, and Sustainalytics and other companies and you as investors will benefit from better and clearer information that is the result from these processes if they are developed well. So let me start with the European side. Next slide, please. In 2019, the EU Commission launched its ambitious Green Deal. It's really about making the EU climate neutral, but in order to do that, it really means a complete overhaul of the EU legislative system. The impact on companies operating on the EU market will be huge, positive and negative. As you look at, for example, the interventions that range from CO2 standards for cars to planting trees to fundamentally changing farming methods. In addition, the EU plans to invest 1,000 billion euros, that's more zeros than I can imagine, in research, innovation and green technology. That's at least 25% of the next EU budget. So this is significant. And there's a sense of urgency. The EU feels that in order to deliver all these plans, it's important to have a good understanding of the contributions that private sector, but also government organizations make to this. So reporting and collecting correct data is of the utmost essence to ensure that progress can be tracked and people are being held accountable. That's why there is a sense of urgency to develop European standards. And that's why one of the first initiatives out of the Green Deal was this overhaul of the non-financial reporting directive. It is also the reason why there's so much pressure on the process to deliver standards as soon as possible. And there's an unwillingness to let that planning slip. And I'll get back to that in a minute. Next slide, please. At the same time, we have seen at the global level within the financial community also a growing realization that ESG risks are important and should probably be more fundamentally ingrained in the financial reporting standards. So the IFRS, as part of its periodic strategy review, launched a consultation to look into what its role would be and whether or not there would be a need for setting up an international sustainability standards board. And they've done an initial public consultation. And based on that, similar to the EU, they have started further work on the ISSB, but also decided to focus on climate as the first issue, and they're working on the draft climate standard. Now, on the next slide, I've tried to put these two initiatives next to each other. And the reason I put it next to each other, there's a lot of conversation currently in the market that these two are competing initiatives. And that's not true. I want to make very sure that we all understand that they are complementary. But there are some essential differences that are relevant to take a look at. First of all, the audiences. The IFRS process, by definition, is really looking at investors and lenders and other creditors, people that need the information to make informed decisions on investments. And whereas the EU is looking at all users of sustainability reporting and all stakeholders, including investors, but definitely not focused on investors. On scope, the EU is looking at all sustainability issues where the IFRS has said they're going to focus on climate first and then start to consider ESG matters. Materiality, EU is clearly looking at the double materiality side, which still feeds nicely into the financial materiality focus of the IFRS. And again, discussions are taking place between the two. How do you make sure that the linkage is covered correctly? And then the last thing that I want to press upon you is the timing issues. So the European Union will adopt under the French presidency, June 15, a corporate sustainability reporting directive. The IFRS is bound to initiate a further discussion on the IASB, launching that at the COP in November, with the determination to set up that board next year. And around the COP, or just after the COP, they will launch their first draft climate standard. Whereas when it comes to the standards itself, the EU aims to have an initial set of standards by November 2022. And that set will include climate, biodiversity, as we just heard about, a handful of social issues, and a couple of one or two governance issues, and overarching standards around approaches and frameworks and management approach. So it will be a comprehensive set that they will launch. It won't be complete, but it's a very aggressive start, if you will. Next slide, please. Let me skip that one. And then next slide, which shows the corporate directive. Because I want to show what's changing, because it's not only that the mandate is changing, that the EU is now looking at double materiality and sustainability reporting. The actual directive that you see the draft here on this slide also lists a minimum list of topics to be reported, and that's already a comprehensive list, but it's also written in a way that over time topics will be added. So the first list consists, out of the top of my head, about 27 or 28 topics, but it will expand pretty aggressively, is the expectation over the next coming years. The other thing is the scope. This corporate sustainability reporting directive will be mandatory for all large undertakings with 250 employees or more and all listed companies. The only exception is with listed companies with under 50 employees. They will be excluded, and SMEs might get a grace period before they have to report. But this brings the number of companies in Europe that need to report under the CSRD to over 50,000 companies. It does require assurance, and there will be all kinds of rules about how to report in a digital machine-readable format, which for a lot of you will be very interesting because it makes comparability much easier to do and much more a reality. Then next slide, please. A couple of observations, and I'm almost done now. So this will happen. The idea that the European Union will still pull back on this initiative is null and void, even though I've been recently on a panel in the US where people were still thinking that the EU might stop this. This is going to happen. The Parliament and the Commission are in fundamental agreement with the need and the overall approach. There are still some issues around non-listed SMEs in high-risk sectors. How far can you go with the inclusion of non-European based companies? But by and large, this is going to happen. And the Commission has also clarified the point that I made already when we discussed about double materiality. It's not going to limit topics that are both financial and impact material. It has to cover both. And finally, my last slide is, well, for us, good news, but I also think good news for reporting organizations in Europe, because Europe and the Commission has been very keen to state that they don't want to reinvent the wheel. And from day one, they have said they would like to build on existing frameworks to reach this goal. Why reinvent? Why create unnecessary burden for companies? So we were very pleased in July that we have been named co-constructor and started our collaboration with the European Union to develop these standards based on our work. And we're now, last week we saw that SHIFT, which is an organization in the field of human rights, also have signed an agreement. So we are really working with the European Union to ensure that the plans are reached, but also to minimize the burden for companies as much as we can, and really try to come to as much of a global alignment as possible. Let me leave it at that. Thank you very much.
Thank you, Peter Paul. We'll continue and discuss some insights together here. So welcome back, Wilco. And Miika is already sitting here with me. So we'll first dive to the deep end. How big is the disagreements among ESG rating providers? How do you see it?
A question for me?
All of you are welcome to answer. How do you see it? How big, how deep is the disagreement?
Well, I'm not sure if there's if disagreement is the right word. So we the ratings that several providers generate and publish, they not only do they have different methodologies, but they also might speak slightly to different things. And I think Peter Paul made a great point in that, impact and risk. So the two dimensions of materiality should be both addressed and not be mingled in a certain way, although they impact each other, but they are really like two distinct dimensions. And I think the ratings that are produced might tend to pick a coordinate between, on those determined by those two axes, without fully respecting the distinctions between the two. And I'm not saying that's right or wrong, but it's just one explanation why certain ratings can vary.
Miika, yeah, please.
Thanks. I think it's interesting when people do look at ESG rating providers and credit rating providers. Credit rating providers, the correlation of the scores is pretty high. If S&P rates something and Moody's rates something, they tend to correlate quite well. ESG rating providers, the case isn't the same, but that's, like Wilco really well said, I think that's not necessarily a problem, because if people weigh different aspects differently or different sectors differently, different ESG criteria differently, that's fine. But I think what I would just emphasize is that the clarity and the transparency behind the analysis would be very valuable for investors to get a better understanding on what is the ESG rating predicated on.
Peter Paul, do you want to comment on that?
Yes, and building on what Miika and Wilco have said, ratings and the rating offerings is very much dependent on the focus of the specific rating agency, but also the ask of the investor that wants the data. From our perspective, it's important that the base data set has the right quality and has been collected with the right rigor that Sustainalytics or any other rating agency can make their analysis based on their parameters. So I don't think it's competition necessarily in that sense. Well, it's competition, but the competition is healthy when it gets to rating agencies, I would say.
In this forum already, we've seen a long list of different ratings and listings or regulations, either already existing or coming, and knowing that different rating and reporting systems, so they also produce different kind of result, which has been a target for hard criticism. What kind of problems has it created?
Well, if I may start off again, I think problems, at least in terms of questions. If we look at the various client groups that we service, some like European clients are so investors, let's say, are different from North American investors. So they might North American investors, when they picked up ESG, they started to focus on materiality, while Europe started to look, like many years ago, started to look at ESG factors more broadly, and then only a little bit later they decided to maybe distinguish those two axes that we already referred to, right? So impact and risk, and so I think it's really up to the investors too, what kind of outcome that they want to get out of the analysis. And I'm not so sure if it's about disagreement or about agreeing that there are differences, and that we, as an ESG provider, we need to be transparent on how we go about data, that we need to make sure the data collection is very rigorous and quality management is robust. But then it's up to the user to determine how they want to use the information and the ratings. It's really the how that's also in the hands of the users.
Sure, I can carry on. Thank you, Wilco. And I think just to sort of stress on the point, it's in the hands of the user to get the understanding to the hand of the user. We would need the transparency behind the analysis, right? I mean, and that's why we need to get really granular level understanding how the score is constructed, because someone, perhaps a bank, might be interested in the sort of likelihood of credit default based on certain ESG factors, but then an investor might be interested in sort of more from a responsibility perspective. And I think those are fundamentally quite different. And without granular hard data behind it that we can all scrutinize, it's very difficult to juggle between the two.
Mm-hmm.
Unna, if I may add one dimension to that. So I agree with both points, but I think that there's also a definition issue here that need to be addressed. I think what this legislation that's been mentioned, for one, will do, hopefully, is create more clarity on what can be considered a sustainable investment, for example. What is a green investment? What's a green bond, and when do you qualify? So some of that, I mean, this is a growing industry, and we're dealing with growing pains, but at some point, this definition will help, just as the data quality will help.
Wilco, as you mentioned before, so for example in social responsibility, many of the definitions are unclear, such as diversity. What kind of diversity do we look at? Is it like gender, color, age, religion? And this makes it really difficult to put them into ratings, even in different cultures. How far, how detailed can we go to?
That is a good question. So where it comes to so we what we do at least is we also based on existing frameworks, based on consultations with clients, also based on many conversations we have with issuers, we come up with a list of criteria and with a, let's say, a scoring scheme to to score certain metrics in a certain way versus other metrics. I think there's indeed only so much depthness that you can apply, given the fact that there are so many differences in how companies approach this. So what you at least want to avoid is that if the framework that we would be using, the methodology that we would be using, gets too granular, that you penalize companies that don't have that level of granularity yet too much. So I think for a rating agency like ours, it's good to have a basic set of indicators that can be populated for the vast majority of companies. Otherwise, your rating outcomes are tilted much more towards, let's say, the non-existence of certain metrics for companies rather than the actual risk or impact that they have on society. So that's a real balance that we need to strike. And in that sense, we as a rating agency are very keen to follow what happens within GRI or within other reporting frameworks, because that is what we will be referring to when we further fine-tune our methodologies.
Peter, do you want to comment?
Yes, please, Unna. So what Wilco started explaining is actually what I meant when I talked earlier about what GRI tries to do is create this global common language through this multi-stakeholder process that we have, where we have, for each standard we develop, we have companies, we have governments, we have NGOs, we have general community, academia, all in that process without anybody being overweight. So what we try to determine in that process, what is at this point in time the societal expectation around this topic. And that will determine what level of detail and what subtopics around, for example, human rights are currently relevant. We also realize that this process changes over time. That's why we update our standards every 2-3 years in order to stay current with the process. But hopefully our standards become, as Wilco says, then the input to the decision models that they use to come up with the ratings.
Miika, biodiversity is also a hot and also quite controversial topic, and rankings between different issues are pretty difficult to make. So what is the biggest challenge at the moment in rating it?
I think we are really at the first, the initial steps. We're taking baby steps towards even understanding how should we even think about it. So I think we are right now, if the topic was climate, I think the year is sort of 2014 or even earlier, sort of where we are realizing that, okay, well, this will be a pretty expensive problem if we don't think about it and if we don't value it appropriately when making investment decisions. We understand sort of what I was mentioning in the presentation. We can evaluate and even rank issues perhaps on the dependencies on ecosystem services. So we can maybe say that, hey, this company is more dependent on certain ecosystem services than another one. That doesn't necessarily mean that it's a worse company anyway, but it sort of just goes to say about the risks potentially of this company if they don't think about ecosystem services appropriately. And then another point is really on the drivers, which I was mentioning earlier. What does the company do towards the drivers for biodiversity loss? And if the company has very large drivers, which are currently not taxed nor regulated, that company is also risky. So I would approach it from a sort of which company is slightly riskier than another one.
Would you please highlight it a bit more, these drivers?
Sure.
In concrete terms, yeah.
Yes, absolutely. So IPBES, which I mentioned earlier, is the equivalent of IPCC for climate. This is for biodiversity, the Intergovernmental Panel. And they mentioned that we have five prominent drivers for biodiversity loss. Climate change is one of them, but also land use change, sort of we are eradicating perhaps tropical rainforests for agricultural purposes. We have pollution is one of the drivers, invasive species, etc. And also then just direct exploitation of natural resources. So if a company is associated with one of those actions, which is completely normal, but if you have very large impacts, then you are risky from an angle of an investor if we start saying one day that, hey, land use changes, we have to regulate it or tax it very hard. So if your business is based on that activity, it's risky, right? It's the same thing as saying you have high emissions, CO2 wasn't taxed in the past, carbon starts having a price, you are risky from the angle of an investor. It's sort of the same logic.
Wilco, Peter, Paul, feel free to comment if you feel like.
Yeah, so I agree. The complexity is part of the reason that nobody ever really wanted to deal with this issue of biodiversity. And I worked a little bit on it in a former life at the World Business Council for Sustainable Development. And part of the additional problem that Miika hasn't raised, but is also there, is the fact that the company that owns the issue and the risk is often, from an ecosystem services benefit perspective, not the company that benefits. So how do you take into consideration that the best outcome overall for society might be the least financially attractive outcome for the company that has the risk? And very simple example, if you have an open mine, you fill it in and you sell that land to a farmer. The farmer is happy, the company is happy because the mine is solved. But if you were to put a swimming pool there and a forest, the whole society would benefit. But so they won't pay back to the company that has to make the investment. So the ownership of the benefits and the costs of the investments needed are much more complicated than they are on some other issues.
But would it be possible to integrate and incorporate biodiversity issues into existing ratings? And what are the barriers? You mentioned complexity already, but would there be a chance?
So for us, like I can only echo what was said. I can't claim that we are at the forefront of, we as Sustainalytics, at the forefront of understanding the issue, getting it reflected in the ratings, etc. We like here, I have to acknowledge we also need to take a lot of steps. While we do see, so now that climate change is broadly on people's agenda, among the larger group of stakeholders, companies, investors, the financial system, biodiversity is getting on the radar, and we get a lot of queries from clients on how we look at those issues. And so we have a lot of homework to do, a lot of ground to uncover. So I think we have to leave it with that. Like, I agree with the concepts, right? So which have been explained by the other speakers, but there's a lot to do in this area.
Do you want to say or comment on that, Peter, Paul?
No, I think we are at the beginning. There is attention. There is a global process with IPAS. Indeed, it's very unfortunate that because of COVID, the global conference around biodiversity has been postponed again, with probably another year. And even though I'm personally not a big fan of these big global gatherings, that is where momentum is created. That is where progress is being made. So having the CBD postponed now again is just not very helpful, because we need to get to the bottom to this, because it is. I agree with the cartoon that Miika showed at the end. I think that is ultimately the bigger risk, because it's where all these other individual topics come together.
Mm. Yes.
And thank you very much for those remarks. And if I may add something really briefly, one way to think about it as well is that when you do climate actions, not all of them are positive for nature, but when you do nature-related activities, quite often they end up being positive for climate as well. So there's sort of that interplay of the two is also very interesting to evaluate. And obviously this is something that the EU taxonomy tries to deal with the do no significant harm principle, that if you do a genuinely climate positive action, it shouldn't hamper the other aspects of the taxonomy.
And as you already mentioned, that it takes decades to see the result of the impact. So they're really difficult to rate in that way, or really prove the impact in the end. So now we've seen many lists, or actually we have a really hard burden of reporting, as we've seen already, and there's more to come and more under process. So what should we all as private investor, company investor, should know about the trends in ESG regulation? Some simple advice to each investor.
I can take a first step, Unna. I think the classic, and I hope I don't offend anybody in the room with this, because I don't intend to. The classic view of a large majority of investors has been to focus on relatively short-term financial impacts. I think what we see through biodiversity as a good example, especially if the investment period is slightly longer, impacts of what's currently considered non-financial impacts will start playing a significant role in the ability of a company to do business, to own its license to operate, to use a very old-fashioned terminology. So and another example is COVID. Nobody saw it coming. And I've been in some companies where we did have pandemic as a potential risk, but nobody saw it coming. I think by paying attention to these ESG issues much earlier, it becomes an indicator of what might come in the near or slightly longer term future.
Maybe what I could add is, if you're as an individual investor, if that's what you're asking about, if you are making up your mind about various companies, and you need to decide in which companies you want to invest, one very important factor, sort of overarching maybe, is the governance structure. So who takes responsibility within a company on those issues? Is this really strategically embedded, or isn't it? And how are the, let's say, the accountability lines for this? And that is at least an indication how seriously certain issues are taken, how like how much, like how long the horizon is that companies are looking at this. And one other indication that we haven't mentioned yet, I think, like you can report on metrics on certain criteria, but what would also be helpful for investors, I think, is scenario analysis. So what happens in a 1.5 degree scenario, 2 degrees, you know, in certain species, whether, you know, how they develop, like create some scenarios and analyze what kind of risk those scenarios would impose on you as a company and how you could respond to that. And the same probably for impact. Like if you have a strategic choice to make, how would you be impacting your external environment in one scenario versus the other?
And where would you advise individual investor or regular people to go and search for that information, which is the most essential for investment decisions?
I think that there are more and more outlets just, you know, readily available where you at least have some indication. Let me just, you know, speak for myself. We have our ratings, part of our ESG ratings are available on our website, just publicly. There's also on like some how you say it, portals like Yahoo Finance, Bloomberg website. They also have not all details, but they at least have headline ratings available coming from Sustainalytics. So that is one. Since we are now under our mother company, Morningstar, I'm pretty sure that on Morningstar's website, there's also a lot of information about not only individual company names, but also ESG information about applicable to investment funds. So that could be a channel too.
Thank you. And Miika, would you have some tips, advice to us?
Sure, I can give it a try. I think those were already great remarks that were said earlier, but I would say 2 brief points. First point is that every investment or investment decision has an impact, and it's up to you to really evaluate and be honest about what the sort of impact is and what are you funding really. And number 2, I think something that perhaps wasn't mentioned in the previous remarks was that I think the time element as well on sort of what trajectory the companies are moving towards. Wilco mentioned the sort of scenarios, you know, in terms of changing climate, for example, but sort of how are the companies transitioning towards low carbon environments? Are they really getting a hold of the low carbon transition or even thinking about biodiversity and reducing the sort of impact on that they might have on biodiversity loss? So not all companies are green yet, but some of them are, you know, on a really good pathway and making the necessary R&D on decarbonizing the activities. And I think that analysis is also very interesting to look at.
Thank you, Peter, Paul, Wilco, and Miika, for your valuable insight into the world of measurement. And also really practical advice here. Thank you so much.
Thank you for having me.
Thank you very much.
Thank you.
Thank you. It was a pleasure.